Hey, folks, welcome to InTheMoneyStocks.com's technical analysis intraday video brought to you by the creators of proprietary price, pattern, and time methodology. Join the PPT, learn it, and profit for life. My name is Gareth Soloway, Chief Market Strategist here at InTheMoneyStocks.com. All right, guys, let's get started today. The market's a massive gap up after a deal on the tax side of the fiscal cliff was reached. And that's really the one that the markets were most concerned about because that would create a spending gap where if people's taxes go up, they spend less. When you spend less, then you stimulate the economy less. And ultimately, it would probably cause a recession. So that deal was reached. The spending cuts haven't been handled yet. That's getting kicked down the road. But again, that's the part the market doesn't like because spending cuts, again, mean less economic activity. So really, this is what you're getting from the best of all worlds with the tax cuts being dealt with. And again, taxes going up on individuals making more than 400,000 and families making more than 450,000 per year. Now, the key here is to understand the markets had already sensed this deal on Monday. So remember, Monday the markets were open. That was New Year's Eve. Tuesday closed because of New Year's Day, and today is Wednesday. So again, today being the 2nd of January, Wednesday 2013, and right now you have the S&P up 28 points, Nasdaq is up 78, and the Dow is up 238. So that's basically 2% ish. Nasdaq's up a little bit more. But the key to understand again is the market had rallied on Monday because we had already heard that this deal was in the works. So you add that Monday event to today's action, and you basically rallied almost 5% on the indices. Right, it's about 4%, I guess you would call it, about a 4% gain. That's exactly what I had predicted to my members inside the research center to happen. And you can go to the daily chart on the spiders here and see exactly what I'm talking about. Now remember, the spiders mirror the S&P 500. So if you take this trend line right here, connect it to this high pivot right there before we pulled back, that's exactly a trend line of resistance. And again, if you look at that, it makes sense that the markets would stall out there because, again, it's where the markets, again, saw resistance prior. And that connected line just drawn straight through gives us that bit of a target. Okay? All right, so off of that, taking a look at a couple other things here. And again, just scanning through, let's go to a couple other stocks. We'll go back to the intraday, but taking a look at Apple. Apple, again, a beautiful move up today, continuing its move from the lows on Monday. And again, Monday, nice little up day there on New Year's Eve. And then today, the day after New Year's Day, continuing its push. The 50 MA here at 560 is current resistance. Okay. One thing that I gave my members, and I even talked about this on the radio interview I did, was that as long as Apple did not close below the 505, 506 level, and remember, when I say a close, that means a close for the day. So if you saw a close below 505, 506 at the end of any day, you would have seen Apple falling to 470 to 475. You didn't see that. Therefore, intermediate move is to the upside here. And where's that 505, 506 level? It's this pivot low right there. So notice no close below. It pierced it a couple times intraday, never closed below. Off to the races. Apple has gone. Now, again, I think Apple will move up nicely, but it will eventually come back in. Eventually, it actually will break this pivot low at around the 500, 505 level, but not for the short term now. I mean, short term, the move is up until it gets to the 50. It might even be able to push through the 50 and go to the 200. We'll keep a close eye on that. Taking a look at a couple other stocks here. Let's see what we have. Okay. And again, right here you have JP Morgan Chase with a nice gap up this morning, but again, a fade on this stock. All right, so we'll keep an eye on that. We've seen a lot of stocks out there, even Apple, Amazon, Google, Baidu, all of them have pretty much faded from their highs. Why do you see the fading today? Well, partially you see it in the markets today as well. All right, so if you go back to the spiders on an intraday basis, you made the highs in the first 30 minutes of the day and then faded off of them. But the reason why you see this fading technique when the markets gap up sizably on news is because right at that opening 30-minute period, that first 30 minutes of the trading day, that's where shorts are panicking and covering. So shorts panicking and covering creates that initial big spike, and then once the shorts have panicked and covered, remember when you cover a short, it's forced buying. Essentially, you're buying the stock back. So once that buying subsides, then the stock floats back down because obviously it doesn't have the pressure of that buying continuing. And that's why, again, you look on the spiders, you have that same type of move. If you go to Goldman Sachs here, same general type. You can see the gap up was at the highs here, and then it faded. JP Morgan Chase, same thing. This one's even more dramatic because JPM gapped up and then really came down sharply and has since gone sideways. Google, take a look at Google. Same thing on Google here. The initial big spike here, and then since then it's come back in just a tiny bit. But the markets, again, are strong today. Going forward, all right, keep an eye on small caps. Small caps are starting to wake up. January effect plays. Be on alert for those. I've already given out one on New Year's Eve to my members, which jumped about 10% that day after I gave it. But the key is to just remember January effect plays just like last year. In January of last year, there were multiple small cap plays that went up 100% plus that I gave to Research Center members. And again, you can take the 7-day free trial here at inthemoneystocks.com. Looking at the market specifically, many of you may wonder where the markets will go, and the easy answer is this. All right, after this initial big push, you will have a market that starts to pull back. All right, many amateurs are going to be jumping full steam ahead into this market. That's the wrong move. Why? Well, because again, what you have here is a market that is still having taxes raised. It's still going to slow because of that. And you have to still deal now with the fiscal cliff side of the spending cuts. And that's 2 months away. So, as much as the politicians tried to get some sort of deal done here, they really kicked the can down the road on the spending cuts and the debt ceiling being raised. And that's going to haunt this market. It's going to keep it from seeing any substantial upside going further. Right? The Federal Reserve will do their thing. We'll see all that kind of stuff going on. But, just keep that in mind. Keep that in mind that the markets will probably top out in the short term. I actually have a negative bias following today's move. All right, so again, we thought the market would rally up to that trend line on the spiders, just going back to that. And if we go to the daily chart, here's your move right in there. Now you're fading off, I think. Again, maybe you inch up a little bit more, but for the most part, I think you start to fade back down. And I'll be looking for shorts actively now. If the PPT is there. Price pattern and time methodology is a proprietary methodology developed here at inthemoneystocks.com. So, again, folks, bottom line is great move on the markets. Profits galore. Again, high risk to have plays, but again, if you had a couple, they're paying off nicely. Now, at this stage, start to look for a fade. Only take shorts if you have the right setups, though. You got to be discerning here. You got to understand what you have and be careful appropriately. Take care. Come join us here at inthemoneystocks.com. And I will talk to you all tomorrow.